raindrops on roses and whiskers on kittens, you can keep them. One of my favorite things is tax-free income, and I'm going to show you how to get some.
Oh, I like money.
Hi everyone, I'm Marc Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. Today I'm talking about how to keep the IRS's grubby hands off your money.
I paid my taxes over a year ago.
That was last year's taxes. You have to pay again this year.
No!
Legally, of course, I pay what I owe because, frankly, the alternative isn't all that great.
I'm crazy enough to take on Batman, but the IRS, no, thank you.
But as Judge Learned Hand once proclaimed, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the Treasury. So, how can you earn income from your investments that the IRS won't touch?
Yo, I told you. Can't touch this.
If you're a stock investor, look at Master Limited Partnerships, or MLPs. These are often, though not always, oil and gas pipeline companies. MLPs tend to have fairly high yields, currently around 6% to 8%. Their dividends are called distributions, and they're considered a return of capital. And you don't pay any tax on the return of capital. Instead, it lowers your cost basis and you pay the tax on the higher capital gain when you sell. So here's what I mean. You buy a stock for $20 and receive a $1 distribution that is a return of capital. You pay no tax on the $1 in income, and your new cost basis is $19. The following year, you receive another $1, again, paying no taxes. Your cost basis drops again, now to $18. If you sell the stock at $23, you'll pay taxes on $5 in capital gains rather than $3 because your cost basis fell to $18 from $20. However, for investors that don't sell, they can collect tax-deferred income for years, and it can be a great estate planning tool. If you pass away while holding the MLP, your heirs inherit it at the price on the day of death, not your cost basis. So theoretically, you could earn tax-free income for years, and then when you pass, your heirs won't owe a dime. And there are plenty of MLPs that raise their dividends every year and would fit well into my 10, 11, 12 system, which is featured in the Oxford Income Letter and my book, Get Rich with Dividends, available now on Amazon and where fine books are sold. But wait, there's more. There's also Muni Bonds. Not nearly as exciting as MLPs, but they make an IRS agent quake in their government-issued loafers. Muni Bonds are bonds issued by local governments to raise money for general purposes or specific projects like roads, hospitals, and airports. Interest on the general purpose bonds are typically paid for with tax revenue, while those individual projects are usually paid with revenue from the project itself, like a toll road, airport fees, etc.
We've gone over the spikes, Tim. We're going to have to come up with 75 cents.
Now, most muni bonds are free from federal taxes and from the state in which the bonds are from. If you live in a different state, you may have to pay state income tax on the interest and capital gains, but not federal. You can currently earn as much as 3.2% on a 1 or 2 year A-rated or higher muni bond, or 3.5% on 5 years, or 4.5% on a 10-year bond. Now keep in mind, that's tax-free. If you're in the 32% tax bracket, that's like earning 4.2% on the 1 and 2 year bonds, 4.6% on the 5 year, and 5.9% on the 10 year. And they are incredibly safe. Over the past 50 years, muni bonds default rate is just 0.1%. Now here is the absolute smartest thing you can do.
Sometimes my genius it's almost frightening.
If you are under 72 years old and don't have to take a required minimum distribution, you absolutely need to contribute to a 401k or an IRA. No excuses, just do it.
Just do it!
Not only will your money grow tax deferred, you'll lower your taxable income in the year you contribute the funds, so you'll pay less taxes. For example, if in 2022 you contribute $5,000 to an IRA and are in the 24% tax bracket, not only will the $5,000 grow and generate tax deferred income, you'll lower this year's tax bill by $1,200. If you contribute to a Roth IRA instead, the funds grow tax-free, not tax-deferred, but your contribution does not lower your taxable income. Thus, this year's tax bill is unaffected. Lastly, 529 plans and HSAs, if you're eligible, are a must. If you're saving for a child's or someone else's education, any funds you contribute to a 529 will grow tax-free and can be withdrawn tax-free as long as it's used for education. The earlier you can start, the better. My wife and I started putting money away for my kids the moment they were born. Well, a few minutes later. Had to calm the wife and then send some emails to my family first. The money grew tax-free for 18 years, and let me tell you, when you save and invest for 18 years without touching the funds and pay no tax, that puts a hell of a dent in the college tuition bill.
You get your order free today. 0 is your total.
An HSA is a health savings account, and anyone is eligible if you're not on Medicare. It's similar to a 529 plan, but for healthcare expenses. The money grows tax-free and can be withdrawn with no taxes in order to pay for healthcare. You're going to pay for healthcare anyway, you may as well do it with tax-free dollars.
What's wrong, Andy?
Just got a headache, and I'm seeing double, and I got a song stuck in my head, and my teeth hurt.
That's like getting an automatic 24% to 37% bump on your healthcare dollars. If your employer doesn't offer an HSA, find a financial institution that does. Tax-free income helps you grow your wealth faster and makes your spending go farther. Uncle Sam is going to come after you hard for his money. These tax-free and tax-deferred strategies will allow you to tell the IRS to step off.
Me? Step off?
And for more information on my 10, 11, 12 system, click the link in the description below. Thanks for watching State of the Market. I'm Marc Lichtenfeld. I'll see you next week.